Hey everyone, welcome back to Corporate Decoder, the place where we unravel the cryptic language of corporate filings. And boy, do we have a report today that makes you wonder if they're selling plane tickets or stocks. Let's dive into Booking Holdings Incorporated's latest quarterly report. This is the company behind Booking.com, Priceline. A go to Kayak and OpenTable, they just dropped their financial update for the period ending the 30th of September 2025, and it is packed with numbers that tell a story about travel in today's world. We'll break down what is really going on beyond the corporate jargon. If you are new here, consider subscribing. We take these dense financial documents and make them easy to understand. Also join our Discord community, linked in the description below for more in-depth discussions. First, let's look at their balance sheet, which is like a snapshot of what the company owns and owes at a specific moment. As of the 30th of September 2025, Booking Holdings had total assets of about $28.75 billion. That is up from almost $27.71 billion at the end of 2024. More assets generally mean a bigger company, but it is how they use those assets that matters. On the flip side, their total liabilities, meaning what they owe, grew to about $33.5 billion from around $31.7 billion. This means they owe more than they own, which is a bit of a red flag. Looking at their current assets, their accounts receivable, which is money owed to them by customers, stood at $4 billion. This is a significant increase from $3.2 billion in December of last year. While it is good they're making sales, a large and growing accounts receivable can sometimes mean it is taking longer for customers to pay, or that the company is having a harder time collecting money owed. Their current liabilities, or what they need to pay in the short term, is just over $16.2 billion. That is up from about $15.6 billion. Among these liabilities, a notable item is deferred merchant bookings, which jumped quite a bit. This represents money received from customers in advance of providing services, and it is crucial to manage this carefully. Now, let's talk about how much money they actually made. Their total revenues for the 3 months ending the 30th of September 2025 hit $9 billion. This is a solid jump from last year's $8 billion. For the 9 months ending the 30th of September 2025, revenues reached over $20.5 billion, up from more than $18.2 billion last year. This shows consistent growth in their top line. Breaking down the revenue, merchant revenues, which is when Booking Holdings directly facilitates and processes payments, were up to $6.1 billion for the quarter. Agency revenues, where they act more like an agent and earn a commission, were down slightly to $2.5 billion. This shift towards merchant revenues is a key strategy for Booking Holdings, aiming for more control and potentially higher profits, though it also comes with more expenses. However, all of this revenue growth comes with increasing costs. Total operating expenses for the quarter rose to $5.5 billion, up from $4.8 billion last year. This increase is driven by several factors, including higher marketing expenses. Marketing expenses alone were $2.3 billion for the quarter, a nearly 9% increase. This makes sense given the highly competitive travel industry. They are spending more to get more bookings and increase brand visibility. A very significant item here is impairment, which was $457 million for the quarter. This suggests that some of the company's assets, perhaps including goodwill or intangible assets from past acquisitions, have lost value and they had to write down their value on the books. This is a clear sign that not all of their past investments are panning out as expected. Despite the rising expenses and that significant impairment charge, their net income for the quarter was $2.7 billion, up from $2.5 billion last year. For the 9 months, net income was almost $4 billion, down from $4.8 billion last year, which is something to watch. The impairment charge definitely impacted the 9-month result. Looking at comprehensive income reveals a similar picture, with overall gains for the quarter and a slight dip for the 9-month period. The statements of changes in stockholders' deficit show that the company has been actively repurchasing its own stock, which can be a good sign if management believes the stock is undervalued. They also paid out dividends, returning value to shareholders. Let's talk about cash flow. For the 9 months ending the 30th of September 2025, the company generated over $7.9 billion in cash from its operations. That is up from $7.6 billion last year, which is positive. However, their investing activities used almost $242 million, mainly for property and equipment. The financing activities section is quite stark. They used over $8.2 billion for financing, primarily due to debt repayments, stock buybacks, and dividends. This outflow is considerably higher than last year's $4.3 billion, as they paid off a lot of debt. In Note 6, we see details on fair value measurements. There is an impairment charge of $179 million for long-lived assets and $203 million for goodwill recorded for the Kayak reporting unit. This confirms the impairment we saw earlier and highlights that Kayak, a major travel meta search engine, is facing challenges, likely due to rising customer acquisition costs and potential competition from AI. The debt section, note 9, is lengthy. It shows that Booking Holdings has a massive amount of debt outstanding, over $17.1 billion in principal. They've been busy raising and paying off debt, with several senior notes hitting maturity or being redeemed. The company is clearly managing a complex debt structure. A key event was the irrevocable election to settle the conversion premium of their convertible senior notes in cash. This led to a significant loss of $360 million for the 9 months, mainly due to amortizing an embedded derivative liability. This shows how complex financial instruments can impact results. In their management's discussion and analysis, they talk about a transformation program aimed at improving efficiency. They expect significant annual savings, which is positive for managing costs in the long run. They are also investing in technology and personnel, which is essential for staying competitive. Looking at operational metrics, global room nights increased by 8% in the third quarter of 2025 compared to last year. This indicates continued demand for travel, a good sign for their core business. Merchant gross bookings jumped by a significant 26% year-over-year for the quarter, while agency gross bookings declined. This confirms the strategic shift towards the merchant model, which, while potentially more profitable, also means higher expenses and potentially lower profit margins per transaction, if not managed perfectly. Their marketing expenses as a percentage of total gross bookings decreased, which is a promising sign of improving efficiency in how they spend to acquire customers. Sales and other expenses increased, largely due to higher merchant transaction costs, which makes sense given the shift to the merchant model. Personnel expenses increased, reflecting higher salaries and benefits. While they're growing the headcount slightly, the focus seems to be on efficiency through their transformation program. General and administrative expenses saw a significant decrease, mainly due to a large accrual for indirect tax matters in the prior year that did not recur. This is a one-time improvement and not a trend to rely on for future cost savings. The impairment charges related to Kayak are a notable risk. Management acknowledges that rising customer acquisition costs and the impact of AI could affect future cash flows. This is a real challenge for the MetaSearch business model. Their effective tax rate increased to over 20%, while they benefit from the Netherlands Innovation Box tax, higher international taxes, and non-deductible expenses, like the impairment charges, push the rate up. Overall, Booking Holdings is generating strong operating cash flow, which is crucial for funding their investments, debt repayments, and shareholder returns. Now, let's put on our analyst hat and look at the bigger picture. Booking Holdings is navigating a complex market. They're successfully growing revenues in room nights, showing a strong demand for travel. The shift to a merchant model is a strategic bet that could pay off if they manage the associated costs effectively. However, the significant impairment charges, particularly for Kayak, are a concern. It highlights the challenges in the online travel advertising space and the potential impact of new technologies like AI. Their huge debt load requires careful management, though their strong operating cash flow provides a cushion. They are also facing increasing regulatory scrutiny globally, which could lead to higher compliance costs and impact business practices. In conclusion, Booking Holdings is a dominant player in the travel industry, demonstrating resilience and growth. The company's strengths lie in its diversified brand portfolio and brand recognition. However, the risks associated with increasing operating expenses, intense competition, potential regulatory changes, and the specific challenges faced by its MetaSearch business like Kayak all warrant attention. The company's success hinges on its ability to continue innovating, manage its costs effectively, and adapt to the evolving digital landscape. That is our deep dive into the Booking Holdings Incorporated filing. What are your thoughts on these numbers? Do you think their strategy will pay off? Let us know in the comments below. If you found this analysis helpful, please give it a thumbs up and subscribe for more corporate breakdowns. And don't forget to join our Discord community. The link is in the description. Thanks for watching, and we'll see you next time on Corporate Decoder.